In the world of UK taxation, HMRC plays a vital role in ensuring that individuals and businesses pay their fair share of taxes. Over the years, HMRC has encountered various tax planning schemes designed to minimize tax liabilities. In recent times, HMRC has set its sights on a specific scheme marketed to individual property landlords as a tax planning option, a scheme often referred to as a hybrid business model. This scheme claims to offer several benefits, including the ability to bypass mortgage interest relief restrictions, reduce tax on property business profits, decrease capital gains tax upon property sales, and even reduce inheritance tax upon the landlord's death. However, HMRC firmly asserts that this scheme does not deliver as promised. To understand the scheme better, let's break it down. This tax planning scheme involves individual or joint property landlords restructuring their property business through the creation of a limited liability partnership, LLP, with a corporate member. Here are the key steps involved. 1. Formation of a limited company. Individual landlords or their family members establish a limited company. 2. Creation of an LLP. Simultaneously, the landlord set up an LLP, with the limited company acting as the corporate member. 3. Property transfer. The individual landlords transfer their properties to the LLP. 4. Profit allocation. Members of the LLP, including the individual landlords and the corporate member, allocate profits on a discretionary basis to reducing the overall tax liability. Landlords are advised that this arrangement leads to reduced tax liability for several reasons, such as no upfront tax costs, reduced capital gain, tax liability in future sale of property, full deduction of mortgage interest, reduced corporation tax and income tax, full relief from inheritance tax. However, HMRC disputes the scheme's effectiveness, citing various pieces of legislation that apply to it. HMRC views that the hybrid business model does not work as it falls under the following anti-avoidance legislation: mixed member partnership legislation, partnership anti-avoidance legislation, transparency of LLPs, and inheritance tax exclusions. What actions should individuals involved in this scheme take? HMRC advises them to withdraw from it and settle their tax affairs promptly. Anyone already involved in this tax planning arrangement can seek independent professional tax advice and contact HMRC for guidance. Individuals concerned about their current tax schemes are encouraged to consider the following actions. Seek independent professional tax advice and settle their position by emailing HMRC at spotlight63@hmrc.gov.uk. Scheme promoters must adhere to the Disclosure of Tax Avoidance Schemes (DOTAS) legislation, which mandates disclosure to HMRC. Failure to comply can result minimum penalty of £600 per day and maximum penalties of up to £1 million. Further, HMRC may publish information about tax avoidance schemes and those involved. Individuals who come across tax avoidance schemes or suspect wrongdoing can report them to HMRC through an online reporting form. Anonymous reporting is an option. Alternatively, they can contact HMRC by phone to report tax fraud or avoidance. In conclusion, HMRC's stance on the tax planning scheme marketed to property landlords is clear. It does not work as advertised and is subject to various legislative provisions aimed at preventing tax avoidance. Individuals involved are encouraged to rectify their tax affairs, while scheme promoters face stringent penalties and potential public disclosure. Staying informed about tax regulations and seeking professional advice are key steps in ensuring compliance with tax laws while minimizing tax liability.